The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college, videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the Board and Reserve banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at @FedEconEd.
Hi, I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards two essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these three key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
I think we're going to get started. Thank you very much for everybody for coming. It is an honor and a pleasure to officially start the 18th Central Bank Conference on the Microstructure of Financial Markets by introducing the Vice Chair of the Federal Reserve Board, Philip Jefferson. Before Dr. Jefferson came to the board, first as a governor and now as a vice chair, he was Vice President for Academic Affairs, Dean of Faculty, and the Paul B. Freeland Professor of Economics at Davidson College. Before that, Dr. Jefferson served as chair of the Department of Economics at Swarthmore College, where he was the Centennial Professor of Economics. Dr. Jefferson's other past roles include being president of the National Economic Association and serving on the Vassar College Board of Trustees and the Board of Advisors of the Opportunity and Inclusive Growth Institute at the Federal Reserve Bank of Minneapolis. I note that early in his career, Dr. Jefferson was an economist right here at the board, and this had to be a homecoming of sorts, as he was born and raised in Washington, D.C. His contributions to economics are numerous, but his research on the causes of poverty may be best known. I particularly like his research using heterogeneous agents, especially his papers published in the American Economic Review on how macroeconomic policies and macroeconomic shocks affect households differently. Perhaps it is not a surprise that I like this research, as in market microstructure, we often study the heterogeneous behavior of financial firms and the heterogeneous effects of policies. On a more personal note, I've learned and enjoyed tremendously working as his advisor for the past 10 months, and I admire him as a person, as a policymaker, and as a researcher, always objective, always learning, always teaching, and always evaluating the impact that the policy choices that he helps shape have on the US economy and its people. Without further ado, please join me in welcoming Vice Chair Jefferson.
Thank you, Clara, for that very kind introduction. It is my pleasure to welcome you to the 18th Central Bank Conference on the Microstructure of Financial Markets. This is the first time that this event has been held at the Federal Reserve Board, and we are very pleased to host the conference. Before I begin, let me remind you that the views I will express today are my own and are not necessarily those of my colleagues in the Federal Reserve System. Our guests include academics from a number of institutions, both in the US and abroad, fellow central bankers, including colleagues from the Bank of England, the Bank of Japan, and the Bank for International Settlements, and friends from across the Federal Reserve System and from several US government agencies, such as the Commodity Futures Trading Commission, the Securities and Exchange Commission, and the US Treasury, including the Office of Financial Research. Now, since this is what you have gathered here to discuss, I do not have to convince this group of the critical importance of well-functioning financial markets for the economy. In my case, coming as a macroeconomist from the academic world to the Federal Reserve has only reinforced that conviction. Central bankers, regulators, and market participants ask a lot of financial markets. We want financial markets to be effective and efficient, and to allocate and reflect all pertinent information. We rely on these markets to help us gauge how the economy is performing, to help us measure market expectations of monetary policy, and even to help us predict how the economy might evolve in the future. We want financial markets to be deep and liquid in good times, but also to remain deep and resilient when the economy is stressed. We want financial markets to be fair so as not to favor certain participants. And central bankers, obviously, rely critically on financial markets for the implementation and transmission of monetary policy. As we have broadened our arsenal of policy tools over the past 2 decades, and as markets have become larger, more complex, and more diverse, I would argue that it has become even more critical for us to understand in detail how financial markets operate. Effective and efficient financial markets do not happen automatically. The precise structure of each financial market, its trading rules, the mix of market participants and the constraints they face, how and how fast information is transmitted, all part of the microstructure of that market, do make an important difference. I think that fact has now become more widely recognized by economists. But it was not the case just a couple of decades ago, when most macroeconomists almost routinely assumed in their models that financial markets would function perfectly in the background. I believe that has changed. Witness, for instance, the growth of macro finance in recent years. And that change has certainly been an improvement. Now, let me say a few words about the first financial market this conference will focus on, the market for U.S. Treasury securities. The U.S. Treasury market clearly remains the largest and deepest government securities market in the world, but it has changed a lot. To quote a recent speech by our former Fed colleague, Nellie Lang, who is now the Undersecretary for Domestic Finance at the Treasury, and I'm quoting, "The market has changed significantly over time with changes in technology, participants, regulations, and Treasury debt has grown substantially," unquote. Some episodes of stress in the Treasury market, including the flash event in 2014, and more recently, the Treasury repo market disruptions of September 2019, and the so-called Dash for Cash episode in 2020, have focused the attention of researchers and U.S. government agencies on the plumbing of the market and on the composition and behavior of its participants. For example, an interagency working group composed of staff from the U.S. Treasury, the SEC, the CFTC, the New York Fed, and the Board of Governors, several members of this group are here today, has been studying a broad range of ideas to enhance the resilience of the market. The U.S. Treasury has also spearheaded initiatives to enhance data transparency. And the SEC has sought comments on several proposals that could materially alter the structure of the market. The Federal Reserve does not regulate markets, but we obviously have a special interest in the Treasury market, in part because some of our policy tools operate through that market, and because of how important Treasury market functioning is to financial stability. And the recent discussions on the Treasury market have involved a lot on market microstructure and market design, including questions such as the following. Is current intermediation capacity of dealers sufficient given the size of the market? Would an increase in the share of transactions that are centrally cleared help that intermediation capacity? Is a decentralized dealer intermediated market optimal, or would an all-to-all market for Treasury securities be more resilient under stress? What are the respective roles of banks and non-banks in this market? Are the incentives faced by market participants naturally leading the Treasury market to become more resilient over time? Or would some carefully crafted intervention be helpful? As you can hear, this list of research questions contains a heavy dose of market microstructure content. Why am I sharing them with you? Just to make my final point. As economists focused on market microstructure, what you do is important, and what you do is immediately relevant. So again, welcome to the Federal Reserve Board. I wish you an excellent conference. Thank you.